Good afternoon, everybody. This is Scott Gillum with the Beginning Options Advisory Lesson number 4, the debit trades. All right, before I begin, I need to remind everybody all rights are reserved and copyrighted 2022 for ShadowTrader. That means the content in this presentation is presented for educational purposes only. It should not be considered as a recommendation to buy or sell a security. Therefore, information in no way should be considered investment advice. Trading options involves risk and may not be suitable for all investors. That means all rights and obligations of the options instrument should be fully understood by you, the individual investor, before entering any trade. In this lesson, we're going to talk about spread trades, the debit spread trades. We're going to talk about the call spread and the put spread. Bullish call spread, or sometimes referred to as a bull call. We'll talk about endpoint definitions and strategies and possible adjustments. Then we'll go to the other side of the chain and talk about put spreads. A bearish put spread, sometimes referred to as a bear put. Once again, endpoint definitions and strategies and adjustments. So let's dive in. The call spread trades. A bullish call spread setup. As we talk about this, remind yourself we're talking about debit trades, pay to play. So our primary instrument is the long call. Our expectation is for bullish. But we would like to mitigate or lessen our debit. So we add the short call for cost reduction, but remembering that we're limiting our upside profit. Our expectation is for a bullish trend in the underlying. Both options will be in the same expiration series. A recommendation is that you use 45 days or more to let the trade develop. Our trade risk is the debit that we pay. That short call that we add decreases the capital invested in the trade, yet it also limits our potential profits. Our maximum potential reward is the difference in the strikes. So if I buy a 100 call and I sell the 105 call, I have $5 of maximum profit, less the debit that I paid. Primary exit. Always have a primary and possibly a secondary. Close the trade at a percent return, 25, 30, 50%. Secondary exit, close this at a percent net loss or adjust into another type of spread trade. So here's the basic setup. A bullish call spread, also termed a bull call or a call vertical with a bullish bias. The top line, I buy the July 200 call for $485. That's $485. And I then also, at the same time, sell a 210 call. Remember, I've got a 200 long and I've got a 210 short. What's the difference? 210 minus 200. I've got $10 of potential. So I pay $485 for the long. I get $131 for the short. This results in that bull call spread. On your platform, you'll see this as a single transaction. Buy, vertical. July 19, 200, 210 call. 485 minus 131 is 354 debit. Here's what they look like on the chain. I'm buying the 200. I'm selling the 210. My maximum risk is $354 on the trade. My maximum profit is the $10 differential times 100 shares, $1,000, minus the $354 of debit, or I can make $646 of potential profit. That's 182% return on the investment if it goes to max profit. Looking at this graphically, piece by piece, I have a long call at the 200 strike that I have to pay some money for. So I have to get it above the $204 price before I start making money on my long call alone. If I look at just the short call, I sell the 210 and I receive a credit of $1.31. Well, the equity could go to $211.31 before I give up all of my credit. 204, 231. Those are my two break evens. Now, combining the two together, I have a break even on the combined trade in the middle. I've got to get above about 202 to start making profits. How can we achieve the maximum reward in the trade? Well, there's two ways. One, we wait for the option's expiration with both options in the money. That means the underlying equity is above both strikes, above the 200, which I could buy the equity for, and above the 210, which I have to sell it for. Therefore, I make the $10 of maximum profit less my debit. Or the short call could be assigned, which means that somebody could say, hey, give me your stock at 210. When this happens, you are obligated to sell the equity at the 210 price, but you own it or have the right to buy it at 200. There's a couple of different actions that you can take to cover the short assignment on this equity. One, you can exercise your long call at 200 and sell it to them for 210. So you make 660. Now, the short call allows me to sell the equity at 210. The long call allowed me to buy it at 200. But I had an initial debit on this trade or this example of 340. Therefore, I had a maximum profit of 660. That's shy of that $10, but it's the differential in strikes minus the debit. But we can do this another way. We can evaluate the net result of reselling the long option to the market and then buying the equity to satisfy the short call. You've got to do the math. If this produces a greater return than simply exercise, then the logical course would be equity is at 220, $10 above that 210 price. However, the long call has a price in the market of $22.50. $20 intrinsic and $2.50 of extrinsic. So you buy the equity to cover at $2.20. You get exercised on your $2.10 short. You sell your 200 call back to the market at $22.50. With an initial debit of $3.40, that gets you $9 of profit instead of the $6.60. This is complicated. This is advanced. And this is not for the faint of heart. But it's another way to look at using the options, using the equity, and using your brain to make more money on your trade. Okay. The trade plan for the bull call. If the equity is trending bullish, I've got a primary exit. I can sell it at that exit. So I close it at a predetermined return on investment. If the equity is stagnating, not what I want, I go to my secondary exit, close at a loss, or adjust into another type of spread trade. Could be a calendar, could be a diagonal. If the equity is going down in price, I'm on the wrong side of the trend. Secondary exit comes into play. I could close the trade or adjust into another type of spread trade, possibly a bear call. Let's go on to the put side of the ledger. We've done the calls. The put side is about 90% the same. These are bearish types of trades. Expectation is for the underlying to drop in price. A bearish put spread setup is a bear put or a what's called a put vertical. Our primary instrument here is the long put. Our secondary option is the short put. It's a cost reduction and a limiting instrument that we use. Our expectation for the equity is bearish. Both options, again, same expiration series. Recommendation is that you use 45 days or longer to let the trend develop. Our risk in the trade is just the debit that we paid. The short call just reduces that capital invested in the trade, but also limits the maximum possible return. Our maximum potential return is the difference in the two strikes minus the net debit. I have a 100 put, I have a 95 put, and I paid $2 for it. The difference is $5. I paid $2, so I have a maximum potential reward in that example of $3. The primary exit, close this at a percent return. Secondary, close the trade at a percent net loss or adjust into another type of spread trade. So let's go through it. Once again, I buy a 195 put and I pay $3.60. I also sell a 185, $10 difference at $1.25. I now have a put spread. If you put it into a single transaction, pardon me, that shows up on the platform, you buy a vertical, you buy to open a vertical of a 195, 185 put at $2.35. $3.60 out of pocket, $1.25 in pocket gives you that $2.35 debit. Here's what it looks like on the chain. I'm selling the 185. I'm buying the 195 and I'm selling the 185 and I'm looking for the equity to go down in price. So my trade risk maximum is the debit of $2.35. My profit is the $10 spread, $1,000, minus the $2.35 debit. I can make $765. Once again, the individual options on a profile basis. My long put, I'm looking for the equity to go this way. I make money from the strike price and my debit. So I make money when this goes from 195 down $3.60 more to 192.40. On the put that I sold, the 185, well, I make money only if it stays above the 185 minus the 125, or 183.75. So my break even is in between these two values, approximately 192, or 191, I'm sorry. Three, two, one. Closing out this, we have a bear put. Buying a put and selling a put at a lower strike. Well, what's the trade plan? Well, if the equity trends not bearish, but bullish, you're in the danger zone. Your secondary exit comes into play. You can close the trade or adjust to another type of spread, possibly a bull put. You expected a bearish trend and it's going bullish. How about in a stagnant trend? Well, you're still in a little bit of trouble because it's not going down. Secondary exit comes back into play. So close the trade at a net loss or adjust into a possible calendar or diagonal put situation. If the equity is doing what you thought, and that's in a bearish trend, your primary exit comes into play. Close this at a predetermined return on investment. Okay, there you have it. The debit trades, the debit spread trades for this lesson.